Options are a fundamental part of modern finance. They are contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset. This asset could be a stock, like shares of Apple, or a commodity, like gold. The contract specifies a price known as the strike price and an expiration date. Imagine you think the price of Apple stock will go up in the next month. You could buy a call option that gives you the right to purchase Apple shares at today's price, even if the market price soars. This flexibility is what makes options so powerful for investors and traders. The core challenge with options is determining their fair price. This is called option pricing. The value of an option is not static. It changes based on several factors. These factors include the current price of the underlying asset, the strike price, the time until the option expires, and the asset's volatility. Volatility measures how much the asset's price is expected to swing. A more volatile stock means there's a greater chance of a big price move, making the option potentially more valuable. Finding this price is crucial for both buyers and sellers to make informed decisions and manage risk effectively. Traditionally, mathematicians developed complex formulas to calculate an option's theoretical price. The most famous of these is the Black-Scholes model. This model uses a set of specific inputs to produce a single theoretical value for an option. For decades, it was the gold standard in the financial world. It provided a logical framework that helped standardize the way options were priced across markets. However, these models rely on strong assumptions about how markets behave, such as assuming that volatility remains constant over time, which is rarely true in the real world. The limitations of traditional models became more apparent as financial markets grew more complex and interconnected. The real world is messy and does not always follow neat mathematical rules. Market prices are influenced by news, investor sentiment, and sudden economic shifts, things that are difficult to capture in a simple formula. This discrepancy between theoretical prices from models like Black-Scholes and actual market prices created a gap. It is this very gap where newer, more adaptive methods, such as machine learning, have started to show their immense potential for the financial industry. Machine learning, at its core, is a type of artificial intelligence. It allows computer systems to learn from data without being explicitly programmed for every single task. Think of it like teaching a child to recognize a cat. You don't write a long list of rules describing pointy ears and whiskers. Instead, you show the child many pictures of different cats. Eventually, the child learns to identify a cat on their own. Machine learning algorithms work similarly. They are trained on vast amounts of historical data, allowing them to identify patterns, make predictions, and improve their performance over time. In finance, this ability to learn from data is revolutionary. Financial markets generate an enormous amount of data every second of every day. This includes stock prices, trading volumes, news articles, and economic reports. Humans and traditional models can struggle to process and find meaningful patterns within this sea of information. Machine learning excels at this. It can analyze complex, high-dimensional data sets to find subtle relationships that might be invisible to a human analyst. This makes it a powerful tool for tasks like fraud detection, algorithmic trading, and of course, asset pricing. The primary role of machine learning in finance is to build models that are more adaptive and realistic than their traditional counterparts. Financial markets are not static. They are dynamic systems that are constantly evolving. Machine learning models can be continuously retrained on new data, allowing them to adapt to changing market conditions. For example, a model can learn how market volatility changes in response to major political events or central bank announcements. This adaptability helps in creating more accurate forecasts and better risk management strategies for financial institutions. This new approach represents a significant shift from relying on purely theoretical models to embracing data-driven methods. While classical models start with a set of assumptions about the world, machine learning models start with the data itself. They let the data tell the story, uncovering the underlying structures and dynamics of the market. This data-first philosophy is particularly useful for option pricing, where the real-world behavior of assets often deviates from the elegant but rigid assumptions of older mathematical formulas, paving the way for more precise and reliable pricing. One popular machine learning strategy for option pricing involves using neural networks. A neural network is a model inspired by the structure of the human brain. It consists of interconnected layers of nodes, or neurons, that process information. For option pricing, we can feed the neural network all the factors that influence an option's price: the stock price, strike price, time to expiration, interest rates, and historical volatility. The model is then trained on a massive data set of historical option prices. By analyzing thousands of examples, the neural network learns the complex, non-linear relationships between the inputs and the final price. Another effective strategy is using models like random forests. A random forest is an ensemble method, which means it combines the predictions of many individual decision trees to make a more accurate final prediction. Imagine asking a large group of experts for their opinion instead of just one. Each decision tree in the forest is a simple model that asks a series of if-then questions about the data to arrive at a price. For instance, a tree might ask, is the time to expiration less than 30 days? And is the volatility above 40%? By averaging the results from hundreds of these diverse trees, the random forest reduces errors and creates a robust pricing model that is less prone to overfitting a specific market condition. Let's consider a simple example. Suppose we want to price a call option for Tesla stock. Using a neural network, we would provide the model with current data, Tesla's stock price today, the option's strike price, and its expiration date a month from now. We would also include data on recent volatility. The pre-trained network, having learned from countless past scenarios of similar tech stocks, would then process these inputs through its layers. The output would be its prediction of the option's fair market price, often more aligned with real market prices than a traditional formula would suggest. These strategies move beyond the rigid assumptions of older models. They do not assume that volatility is constant or that price movements follow a specific, predictable distribution. Instead, they learn these dynamics directly from market data. This allows them to capture nuances that traditional models miss, such as the volatility smile, where options with the same expiration date but different strike prices have different implied volatilities. By learning from real-world data, machine learning provides a more flexible and often more accurate tool for pricing options in today's fast-paced markets. The real-world application of machine learning in option pricing offers significant benefits to investors, traders, and financial institutions. For traders, more accurate pricing leads to better informed decisions. If a machine learning model identifies an option that is mispriced by the market, it creates a potential trading opportunity. This can lead to more efficient markets, where prices more accurately reflect an asset's true risk and potential return. For financial institutions, these models are invaluable for risk management. They can more accurately calculate the risks associated with their large portfolios of derivatives, helping them hedge against potential losses. Consider a hedge fund that manages a complex portfolio of options. Using a neural network-based pricing system, the fund can get real-time, accurate valuations for thousands of different options at once. The system can continuously learn from incoming market data, adjusting its pricing models as market conditions shift. This allows the fund's managers to quickly identify and react to risks, such as a sudden spike in market volatility. It also helps them spot profitable arbitrage opportunities where an option's market price deviates significantly from the model's more accurate, data-driven valuation, thereby enhancing profitability. Looking forward, the future of machine learning in option pricing is incredibly bright. As computational power continues to grow and more sophisticated data becomes available, the models will only become more powerful. We can expect to see the integration of alternative data sources, such as social media sentiment, satellite imagery, and news analytics into pricing models. For example, a model could learn to adjust the price of an agricultural commodity option based on real-time weather patterns detected from satellite images. This would provide a level of predictive accuracy that was unimaginable just a decade ago. The ultimate benefit is the potential for more democratized and intelligent financial markets. As these tools become more accessible, even individual investors may be able to leverage them to make smarter choices. The combination of human expertise and machine intelligence promises a future where financial risk is better understood and managed. Machine learning is not replacing the human element, but augmenting it, providing powerful tools that help navigate the complexities of option pricing. This synergy will continue to unlock new possibilities, making markets more transparent, efficient, and resilient for everyone involved.